Welcome everyone to the first webinar of 2021. It's great to be back and with you all as a community. I think most of you do know me, but for those who don't, I'm Sarah Corley and it's my job to lead on the community activities at DFI, bringing you things like webinars, communities of practice, and our cultivated knowledge bank and league on digital finance professionals on LinkedIn. And I'm really excited today, A, because one of my favorite ever locations, the country of Uganda, is featured in our image in front of us. But B, because we're going to talk about a topic that I think is very interesting anyway, but with the COVID pandemic that is around us, financial vulnerability and financial resilience and financial health have really come into the forefront of things that we need to be talking about now. And I think micropensions is one of those ways in which we can contribute to people's financial resilience and financial health, especially in old age. So I'm absolutely delighted to have Beryl with me today. Some of you may recognize Beryl because she's been on some of our DFI courses and is also very close to becoming CDFP certified. So that's fantastic. And also incredibly experienced, the CEO of Blueprint Pension Services. So she's going to be handling our webinar today, and I'm very, very much excited to hear from her. Just one quick thing of housekeeping before I hand over to Beryl. We would love all of your questions. So as the webinar is going on, please feel free to pop your webinars in the Q&A function. So you'll see that if you scroll your mouse towards the bottom of the screen, pop your questions in there and you're welcome to put them at any point. Beryl and we'll be taking questions throughout the session today. And do make sure you ask any questions you have to her. And we look forward to hearing your inputs, your thoughts, and maybe even ideas that you have as well on some of the topics. So without further ado, let me hand over to our guest speaker today, Beryl van Andel.
Thank you, Sarah, for that introduction. My name is Beryl van Andel. I'm from the Netherlands, and the past 5 or 6 years, I've been very fortunate to be working in the sphere of micropensions. Financial inclusion is something I'm very passionate about, and I really believe that savings can support the resilience of many people around the globe. It's a pleasure to be here today as part of the DFI webinar series 2021, and I look forward to a lively discussion. As Sarah said, do bring questions up during the presentation. It makes it more interactive, and when I see some interesting questions coming in, I'll go into those immediately. But I would like to start with a question. Do you know what the average life expectancy worldwide is today? So for a child born today, what is the average worldwide expectancy? So, or you can put it in the Q&A, or you can just keep it in your head. How old do you think somebody born today will be? The correct answer is 73.2 years old. This is a figure provided by the United Nations Population Fund. For women, the number is 75. On average, women outlive men by almost 5 years. Are you amazed? Maybe, maybe not. If we look at the map you see here, Asia is mostly colored dark green. This means the life expectancy there is between 70 and 75. But on the other hand, you see the African continent, where I think a lot of you participants are from. Life expectancy is lower. It's 65 for women and 62 for men. And within the continent, there are also large differences. And also, please realize that somebody that is 65 today, in 2021, could expect to live another 17 years. So that would be living up to 82 years old. In this webinar, I will address the challenges of the demographic and cultural transition we are in. We will have a look at social protection and the importance and need of long-term saving, with a special focus on pension schemes. We will look at what a micropension is, the design of a successful micropension product, and how to leverage digital infrastructure to create effective distribution. And along the way, I will touch upon lessons learned from several micropension implementations around the world. My goal of today's webinar is that you will understand what the 3 key issues in saving for long life are and preventing old age poverty. By 2050, 1 in 6 people worldwide will be over 65 years of age. And this is not a guess or an estimate. This is kind of a certainty. All these people have already been born. I'm one of them. In this graph, you see that the majority of older people will be living in developing countries. Population aging has been fastest in Eastern and Southeastern Asia and Latin America. Today, about 1 in 3 older people, so above 65 years of age, live in Eastern and Southeastern Asia, 260 million to give you a number. Aging in these countries is still very much on the rise, as you can see in the blue line on the right side of this graph. In 2050, about 22% of the population in Asia will be over 65. This is an estimate of 570 million older people. Another important aspect to understand is the gender ratio for older people. As women tend to live longer than men, for every 100 women that are 80 plus, there are less than 60 men in that age category worldwide. At the same time as humans live longer, birth rates are declining as well. Improvements in hygiene and sanitation and healthcare, agriculture, education, etc. have all led to a decline in infant mortality and therefore lower birth rates. On this slide, you see the effect. And the fact is that declining birth rates combined with increased longevity creates the demographic transition we are in. The older generation have fewer offspring to take care of them. And most adults these days are less likely to live close to their parents and grandparents because of urbanization and migration. These factors all lead to an increased risk of old age poverty. If you like this kind of data, I suggest you have a look at some of the amazing videos of Hans Rosling. This longevity risk we are looking at is grossly underestimated across the globe. The UN, in their latest report on aging from 2019, stressed that preparing for the economic and social shifts associated with aging population is essential to ensure progress toward the achievement of the Sustainable Development Goals. While you may now have a view of herds of older, needy people, please realize that today somebody in the age of 65 is very active. In many countries, they start new careers, they run businesses, or even run countries at the age of 77. In the US, economic studies have been done into the 50 plus age group and their economic contribution to GDP. And that will triple in the coming 30 years. A part of this age group will have significant income, assets, and pensions, so money to spend on all kinds of products, etc. This effect is called the longevity economy. There is an estimate made by the UN a few years ago that if no action is undertaken, 1.2 billion older people will be living in poverty. This is an amazing number, and things need to be done, so to say. So how do people see how their life will look like when they are older? In Uganda, we did a feasibility study amongst Visalis, and most people think they will need to stop working for health reasons, or they will just be too old to work. And about 7% think they will never stop to work or retire. And this percentage of around 10%, we see that in many feasibility studies around the world, that people just estimate that they will have to work until their last day. So it is important that structures are in place to support older people. This is a map of the world with old age pension beneficiaries. You see that in the Northern Hemisphere, there are many pension schemes in place, but there are also parts of the world where only up to 20% of individuals have some kind of old age pension. And this is an old age pension that could be a non-contributory pension that is for everybody, or it might be a means-tested pension for those that are very poor, or it could be a contributory system. So for people in the formal economy, when they have salary, some of that money is put into a pension account. But in countries where the informal sector is very large, there are hardly any solutions that really work. They're just not available. I was very fortunate to work on a project in the Solomon Islands during a few years. In 2017, we did a feasibility study, and after that a pilot into the willingness and ability of people to save for old age. The product was piloted and was very successful. From the start, it was very clear that financial education was very necessary for people to understand what the benefits of a micropension would be, and also to teach them how they could pay into their pension account, etc. Here you see Mary. She was a lady living in the Solomon Islands. She is a widow and has a daughter, and she runs a canteen where she sells drinks, etc. And what she said is that she was so grateful that she had the possibility to save for old age. And once she started saving, she had never had a bank account before. She was one of the top savers with YouSave. That's the name of the product we created in the Solomon Islands. And there you really see what saving for old age can mean for an individual. One of the key features for the success of the YouSave product is that we designed what we call a two-account principle. So every deposit made into the pension account would be split 50-50 in two accounts. One is the general account, that would be a short-term savings account where withdrawals are possible for life events. Say if somebody needs to go to a hospital, if there is a marriage in the family, etc. And the other part would be the preserved account, where the money is kept and earns interest until a pre-established pension age. In the Solomon, the pension age is 55. And added to this, there is an insurance component. It's called a special death benefit, which pays out when the member would die, and funeral costs could be paid of that. And the family of that deceased person would have some income. And this is this account principle, I would say, is something that has been created in the past few years, and we see that has been copied in many other countries. Because from the beginning in the Solomon Islands, digital payments did not exist yet, we tried several things to create a way for people to deposit digitally, because it's not very cost effective if somebody has to go out to the market to register people and collect payments every week. In the beginning, the team really did that to build trust with the members and to make sure they understood the product, etc. But over time, first they created a proprietary agent network, where they actually used an app from ANZ Bank to take cash deposits for agents and transfer that money back to the bank. And then later on, they trialed payments through airtime, which was a very interesting collaboration between the mobile operators, the government, and the National Provident Fund to see if it would be, if people would deposit more, if it would be made much easier, because the penetration of mobile money is still only 10% or so in the Solomon Islands. And this led to many more deposits as it was so easy to do. So this is an example of really nice innovation, in my opinion, between several parties there. Another pension scheme that is distributed in a slightly different way is the Mbao product from Kenya. It is a product that was created by the government. It was already introduced in 2011, so quite some time ago. And it also worked through M-Pesa, which made it very convenient. But the uptake has not been great until now. The Association for Informal Workers, UAKALI, was set into place to do distribution, but somehow they did not manage to really get a lot of traction. And at the same time, in several reports written about this development, they say that the registration platform didn't work very well. There was a lot of downtime. Because of that, there was lack of trust. There were some issues on the administrator, etc. So here you see that not only this distribution part needs to be very well managed and the payments part, but also the trust in the institutions, and that the back-end platforms need to move very smoothly. Because if you're going to put your money into a savings account for the coming 20 or 30 years, you want to know your money is safe. You would want the same, right? I see here a question coming in from Miguel. The case study of USAVE in the Solomon Islands is interesting. Do you have a report or link to the report? I can send you several things after the webinar, Miguel. Don't worry about that. Then let's look at what a micropension is, so to say. A micropension is an individual savings account where you can save really small amounts. So maybe you would only save a penny a day, but in the end, if you do that 30 years, you will create some assets, and these assets are earning interest. So the idea is that it's individual savings with collective investments at the back, and that is how you earn the interest. So an institution offering these micropensions should have an active investment strategy that is not very risky. And further, a micropension scheme is catered to informal workers, and that is why flexible deposits and withdrawals are very important, because somebody selling fruits in the market may not have the same income every day. And also a micropension product should address the medium as well as long-term needs of people. And it goes without saying that the organization needs to be sustainable and very low cost, because in general, in micropension schemes, people will save up to $150 or $200 a year, American dollars. So you can't have very high cost. You need to run the scheme at a few dollars a year per participant. You have to make sure that after cost, there is still interest for your savers. Then if we have a look at do people save? Because I've been asked that question many times. Yes, but these informal workers that live hand to mouth, are they actually able to save? And yes, poor people do save. I guess many of you at DFI also know this because you understand what kind of people we're talking about. And people do save. They save to prepare for costs that they have over time. If these are school fees, or they want to save for events happening, accidents, etc. And they save in many ingenious ways, I would say, but they do it very much informally. And then the ability to save, there are different theories about that. You have Keynes, he is a famous economist who says the basis for your savings are your current financial situation. So depending on what you earn today, you are able to save. But his competitor, Friedman, he thinks savings are based on your future expected financial situation. So if you know that you will be earning more next year, etc., you'll maybe save less, or if you know you have hardship coming up, you'll save more. And then there is Modigliani, who takes the demography into the equation. He says that, like, if you're at a young age or as a student, you will get loans to be able to take care of education and things like that. And then during your working life, you will build up assets and you will kind of de-save by the time that you are old. We also see gender differences in saving. Here you see some numbers from a feasibility study we did in Vanuatu. And actually, in most studies, we see that men save higher amounts when they save for pension, and women save lower amounts, but save more often. So you cannot say one saves more than the other, but they save in different ways. And here you also see that men in general save more when they're older, and women you don't tend to see that pattern very much with women. And in this particular study, it was interesting to see that the women between 30 and 39 had much higher savings than the average. And for the urban sample, that was even twice as high as this, which is not very logical because women in this age category tend to invest in their children. Other things we see when we look at gender is that if there is more equality within society, we see that there are higher domestic savings in a country. And also, if we look particularly at women, that single women tend to save more than married ones. The married ones will rely more on their husband, etc. And also, when divorce rates are higher in a country, there are more savings by women than in places compared to where divorce rates are lower. Then you would want to know if people say, oh, I'm quite interested in a micropension scheme, I would like to save, what kind of percentage of their income would they want to set aside? Because the idea of saving for pension is when you have your income, you put money aside immediately before you start spending. It's not I spend, and if I have something left at the end of the week, then I'll save for my pension. And here in Uganda, we saw that the majority of people would like to save between 5 and 10% of their income. And this is what we see in most countries. The average is around 10%, sometimes a little lower, sometimes a little higher, but that's what they do. And the interesting thing is when we go into pilot phases and people actually save, in general, we see higher savings amounts from the active savers than we expect there to be. But that also accounts for averages, of course. Then I would like to look a little bit more at distribution. because only having a good product that tapers to how people save, etc., is not enough. The distribution is very important, and in the distribution you have to take account of financial education, take into account financial education, because many people are not aware of what it means to save, or that you can actually save for old age. In general, when I was in interviews with people in the field, they all saw this issue of growing older and they're not expecting their children to take care of them in old age, but that you have to take action from 25 or 30 years old. That was not so much instilled. So this is an important part of the distribution. Then, of course, registration and identification of these people, because identification is very important. If you're keeping savings for somebody, you want to be sure that when they come to collect these savings in 30 years' time, that you have the right person in front of you, or if somebody deceases and the saved amount will go to their offspring, it's also very important to have identification in place. And here I'm very excited to see what's happening in that sphere of identification around the world. Then if you can leverage payments options for as well deposits as withdrawals, then you can make it so much more cost effective, because going out into the field and really talking to people and collecting deposits is expensive. But in many cases, you need to do that to build trust. Most of the projects I know and have been involved in, they started off with low levels of digital distribution. So having physical people, agents going into the field, etc., to understand what clients' needs were, to build trust, etc. And then over time, evolving into a more digital scheme, so to say, that would be much more low cost, because in the end, the distribution has to be low cost. Here I see a question from Gerald. Is there a relationship between the level of education in general and financial literacy in particular to savings? That's a very good question, Gerald. But I couldn't say that there is a very clear relationship there. I do know that in countries like, for example, in Fiji, I know they do that, where they already do financial education at primary school level, that people, when they are older and start working, etc., that they are much more aware of how to deal with money. But I don't know if there is a direct relationship. Well, in general, you could say people that are higher educated will probably know more, but I also know people, for example, in my own country, that are high educated and have not done anything for their pension. So it's a good question, and it would be interesting to look at that further. Then in distribution, I'd like to give an example of People's Pension Trust. They are a private initiative in Ghana for micropensions. They started, I think, around 2012 or so. And this is really an example of where they started with only physical distribution. They had paper forms. Their pension managers, as they were called, went out into the field to talk to people, to educate them, to sign them up, together with them make a pension savings plan, and then people would start saving, and they would go out to certain locations to collect the money. They actually at a certain point had kiosks at marketplaces where people would come, and they really built trust. But over time, they created this online pension journey where they had an administration in place where clients through smartphones or first only for USSD menus could log in, but also the pension managers could log in, and group leaders from certain communities could log in to support the whole savings mechanism. And the administration would also be used for regulation, control, etc., and pension investments. There are different micropension models around the world. The differences between these models is that they are, like in Kenya and Rwanda, there are government-led models, so to say. In many places, in the national financial inclusion strategies, micropensions are being taken up as an important part of financial inclusion. But the choices made by governments of who is in the lead are different. So in Rwanda, for example, there is the Eyoheza scheme that was introduced in 2019. It was really supported heavily by government. It also has a part where if you save up to a certain amount and you're in certain income brackets, you get co-contributions of the government. And it's a fully digital rollout. So you can download the app on your smartphone, you can enroll into the scheme, start saving, etc., or you can go online and enroll, etc. So that is really a very new and very digital experience. And I think it's a good example of a deployment that has looked at a lot of other initiatives that were started earlier, and they took all the good elements out of these, like the two-account principle is also in there. India has quite a long history on micropensions. They introduced a first micropension product more than 10 years ago, I would say, which was kind of working, but it was all physical distribution. 5 years ago, it was replaced by the government by NPS Lite. And until now, it's the question how successful it really is. The distribution still runs through NGOs and MFIs. But the fees for distribution were slashed in half 5 years ago. And because of that, it was not very interesting for the MFIs to offer this to their clients. So it is to be seen, but a very interesting aspect of the NPS Lite that was introduced a few years ago was the idea of gift a pension. Where somebody can register, sign up for a pension scheme for a third person. So if you employ a maid or a gardener or have a family member you would like to save for pension, you can sign up, you can do this online, and that person only needs to do the identification for himself. And also the system is linked to the national ID. And I think that's a very nice example of how you can also create pension inclusion by creating awareness with employers to save for somebody's pension. Then there are also countries where you have more private-led initiatives, like in Uganda, you have the Mazima Retirement Fund, in Ghana, People's Pension Trust, as I talked to before. And for example, in Nigeria, they created guidelines for micropension in their new Pension Act in 2018. And they have said the pension funds are the ones to be in the lead. Until now, there have been some pension funds that offer micropensions, but it has not been very widespread. So the uptake is very low. This is interesting because the market for a micropension is very big. I think there are 65 or 68 million people in the informal economy in Nigeria. But I guess it has to do with the different way of working and different mentality an existing pension fund has to adopt to cater to the needs of informal workers and go out and reach out to your clients. And then we have the Pacific region. I talked about USAVE briefly, and in Vanuatu there's UMISAVEM. They are all adopting schemes that are run from the national provident funds. And some are successful and some are being delayed because of regulation not yet being in place. So we'll see how that develops over time. It looks quite promising. As I said before, the most important aspect of pension inclusion is access to good products to save and regulation around these products and the usage of these products. And usage is important because if you have a pension account, but you do not save on a regular basis, in the end, you will have no assets to live off when you're old. And to create these two things, several barriers have been identified, where digital transformation is a very important one. And I think that this is going really fast, and we see different initiatives being taken up to create pension solutions. And regulation, so policy for micropension and regulation that is in place is also very important. In many places in the world, formal pensions are regulated, but informal pensions are not yet part of that. So to be able to offer a micropension product, that regulation needs to be in place. And in some countries, interesting sandboxes can be created to take steps further, but in other countries, like we saw in Vanuatu, that is more difficult. And then the financial education I talked about before is really important. We also see that in countries where the government is committed to creating micropensions, things roll much more smoothly. So this commitment is important. And of course, at the bottom, we have economic development. If people have more income, it's easier to save. And that one will be very exciting, or exciting is maybe not the right word, but it will be interesting to see how that develops in the coming years, because COVID has hit many regions very hard, and especially informal workers. So will they be able to save? But at the same time, it also shows that if you have savings in place, you will be more resilient. So for example, in the Solomon Islands, the normal withdrawal rate of the general account was around 10%. And we saw during the first wave of COVID, March, April, May, etc., that much more withdrawals were done. On the one hand, you can say, oh, that's a shame because it's their savings for old age. But on the other hand, it was a cushion which helped them to go through a difficult period. At the beginning of the webinar, I promised you that I hope that you would see 3 key issues in saving for a long life. The first, in my opinion, is the availability and regulation of financial long-term savings products. The second is cost-effective distribution, and technology has a very important role to play there. And the third, I believe, and we've not touched upon that very much today, but I think that is to stimulate recurring savings and really build trust as organizations offering micropension products. And I think it will be very interesting to see now that quite some schemes have been deployed, and we kind of know what kind of product works well and different ways of distributing, and we kind of understand the basis, but there's still a lot of work to do to see how people will really save. Because also in schemes you see that only half of the people really saves well. Another part that is registered just saves a few times, but saving a few times will not lead to the effect you wish to accomplish. So I really look forward to exploring that area further in the coming years and understanding how, or through nudging or through different kind of design, we can stimulate people to save more. And not only for old age, but also saving more for in a month or the medium term. Okay, with that, I get to the end of my presentation. I'm open for questions now. Please feel free to ask them. So who can I give the floor, Sarah?
Well, I've got a question to start off with before we wait for everyone else to put their questions through. So keep hitting us with questions, guys. We're really wanting to hear your thoughts, views, opinions, questions that you might have. So use the Q&A function for us. But yeah, I guess it's sort of a question and a comment really, that we often think that people in low income or irregular income, as well as we're talking about, don't want to save, but that's not the reality at all, is it? They want to save, but it's just the access that is one of the big issues, and the education around how to.
Yes, definitely. They do save, and sometimes people have ingenious ways of saving. They might have like a neighbor, they would give some money to, like, to be sure they do not spend it, or they would have several jars with several labels on them to save. Or sometimes people also save in different ways. Like in Ghana, there is a traditional way of saving that they buy a fabric. You have this printed fabric, and they are very, how do you say that? They don't lose their worth. So if you invest in such a piece of cloth, with inflation, it will hold its worth. And if you have a situation in your family, you could sell the cloth in 5 years' time and get the same sort of worth for that. And you see the same thing happening in India with gold. And you see people just putting money in their mattress. But the problem with many of these informal savings mattresses is that if there is a storm or a fire or theft or things like that, they lose all of that. And also, if you have savings in a formal way, you could also use these savings as a collateral to get a loan or things like that. So once people get into a more formal way of savings, not only micropension, but also other saving schemes, there are more possibilities open to them.
And that's what we're trying to encourage, isn't it? Making sure that that money is working as hard for them as it possibly can do. Yeah. Peter's question is quite interesting, about what can happen with things like hyperinflation, or, not actually having any of these savings, earning any interest, and affecting sort of people's savings. And what can we do to try and prevent those kind of episodes from happening?
Yeah, the episodes of hyperinflation are, of course, difficult, so to say. Many pension investments, micropension investments, tend to invest in country only, because in that way, if you have high inflation and things like that, so there will be like government bonds for half a year or a year, and they are set. So you kind of dampen that effect a little bit. And also, with investing in your own country, the interesting thing is that you can use the collective savings of a large group of people to invest in your country. Actually, in that way, in the Netherlands after the Second World War, they used the funds of the pension funds to invest in hospitals and roads and things like that. So while individuals were earning interest, the country got rebuilt with those savings. So that can be a very interesting aspect of formal micropension savings.
And I think Miguel has also got a really interesting question. So he's asked, designing a digital micropension scheme can be expensive as complex. in addition to the distribution as well, which we've heard from you, it can be complex and time consuming, certainly at the beginning. Where do you see the private sector playing a role, and what kind of investments are needed?
That's a very good question, because it's where it starts. You need quite large investments up front for micropension schemes. That is very clear. And you also need a long-term perspective. So in economic run-throughs we've made for several projects, we see that on average you need 8 to 9 years to become cost break even. So that's quite a long time, because you need large scale to be cost effective. And so you would need a minimum of maybe 250,000 people actively saving if you have a standalone organization. So within a national provident fund that already caters to the formal economy, those numbers are a bit different, because they already have an organization, investment strategy, etc., and they can just piggy bank on that. But for private endeavors, you need a long view. And I think for micropension, it's very important for private initiatives and governments and institutions to work together to create something that is workable. And that's what I like of the example in Rwanda, that it is a government led initiative, so to say, where there's also co-contribution of the government, but they have done it in a way that they got all private parties involved in the development of it and running it, etc. So I think that with current technology, a lot can be done, but you also need that distribution to be in place where you reach out to people, do the financial education, financial literacy part. So there, if a government and private sector work together, they can both do a part in that.
Mm. And I think you've also touched on Mohammed's question, which asks about public-private partnerships. But he was asking, in particular, have you got any examples of where they've used mobile banking agents or other actors for the cost-effective distribution?
Yeah, no, it was in the Solomon Islands. There we created, with the National Provident Fund, we created a cooperation with ANZ Bank because they were launching their mobile money platform, but they needed use cases. And we saw that you have these agents in different islands, because Vanuatu has many islands. That would be from one telco an agent, but not for another. So we said, why don't we try to get these together? So you have one location, you will have an agent of one mobile money provider, being ANZ Bank, one mobile operator, and then also have that person being an agent for NPF. So there, from the Provident Fund, we used the digital infrastructure ANZ was building, and we gave training to these agents, and we said, let's have these agents be agents for the three of us, and in that way leverage the energy to be put in there, and also make it more interesting for these agents to become an agent, because these places are not very crowded. So if they would only be an agent for one mobile operator, or just an agent for NPF, the fees would be hardly anything, because they would have one customer coming in per day.
And does that help with trust as well? I mean, do you think so from a customer perspective, if you see the person and they come from other trusted brands as well, so we often know that mobile money operators have a better name in some places than banks do. Does that help the customer trust as well, do you think?
Yes, I think it helps. It definitely helps when they see a known face. But also within these communities, because communities are small, they know a certain person is trusted. So choosing your agents is very important to understand the role of that person in the community. But I think it definitely helped to get people to use their mobile phone in doing payments and trusting a service like this where they would get an SMS confirmation, because most people use old-fashioned feature phones, but then they would get an SMS and they would understand, I've deposited my 20 Vatu and now my balance is so much, and the agent would really be well trained, so could really help them. And that was a very important aspect. Like the team in Vanuatu actually went on a trip to Uganda, which was organized by the UN, to see how agent networks in Africa work, because they had never seen an agent network in place. And that was very interesting, because they learned so much, and in that way they could learn from each other, and then they created a fantastic proprietary agent network.
It's amazing, isn't it, that when we start to think about how we reach out to people to within low income areas or areas like a bit informal where income comes in, but it has its good and bad days, it sort of can go up and down, that actually the role of the agents to be almost like befriend, be respected, be trustful, know what life is like. That's the kind of people we need to build trust and build that initial interaction to then move people along a line of digital transformation, so they began to trust and embrace that digitalization of services more.
Yeah, and actually what was also interesting in this case in Vanuatu is that the agents themselves, when we told them about accepting deposits for savings, etc., when they understood that more cash would be coming in, their eyes kind of lit up, because their issue would always be that they would run out of cash, because people would come to them to withdraw cash, and then they had to take a boat to another island where there would be a bank, and to get airtime back into cash, etc. But then when they understood, so people will be coming here with cash and depositing that, and that makes like your in and out more manageable. And that was also a very nice aspect of this collaboration, managing the float.
Yeah, and I really enjoyed the example that you gave, where the 50-50, so half of the savings money goes long term and the other half is available short term. Because I think I remember having long conversations with Ignacio on one of our other webinars about that when we're saving, we can't always save everything for long term. We don't know what's around the corner. So actually having that flexibility of use, but also making sure that some of it does remain protected, that we can't get at all of it, will help. And you said that a lot of people have replicated that model. Is that one that you would recommend to anyone on this call that are thinking of introducing this kind of product? Yes,
I think that is key. And you see the split in different ways. Like the product in Rwanda, Ejohaza, is a 60-40 split. So 60% long-term and 40 general accounts. And in Fiji, I've even seen 70-30. So that kind of depends. And then you can also play with things like in Ghana, I know they have a 50-50 split, but all the interest on both accounts goes into the preserved account, so the long-term account. And in that way, the long-term account grows faster than if you would have interest accruing on both. So there are different, because the goal, of course, is to accumulate savings in the long term, but not compete between saving for tomorrow or saving for in 10 years, not compete too much. It's a very nice mechanism. And it also really helps to install trust. We've seen in many implementations that people would say, but how does this work? Can I withdraw anytime? And then they would put in money, and actually 2 weeks later, take out some of the money just in the general account, just to make sure if I need it, can I get it? And how does the process work? So there it's very important, if you start piloting something like this, make sure that the withdrawals from the start work very well. Because sometimes you think it doesn't make sense to withdraw money in a week's time, so we can do that later. But actually, you need to have all these processes in place to build trust. Because if people do that and they say, I got my money immediately, it was easy, it was smooth, they'll tell everybody. And those are your ambassadors for your product.
And it is a weird thing, isn't it? I mean, going to thinking about saving and putting money somewhere that you're not going to touch for maybe 20 or 30 years. It's an indifferent and a different concept to sort of try and understand if you've never really thought that way before.
Yeah. Yeah, and some models, like the Mbao model in Kenya, they promote it as a micro pension. But actually, if you look at the small print, after 3 years, you are allowed to take your money out. So actually, some people have done that. And in a way, maybe it's better if you are able to take it out, like if the government is unstable or something like that. But on the other hand, you don't reach the goal of saving long term. So there are different models there. But I think there's also a lot of room in the market for creating savings products that have a horizon of maybe 5 years or 10 years, that may be housing loans or housing savings or other kinds of savings. Because savings is also something you need to get into the habit to do. And in general, when somebody starts saving and saves for a year, like every week during a year, then they'll keep saving the rest of their lives. Because saving, it's a habit forming, and also savings gives you gratification, so to say. Like if you've been saving and you've been doing it every week and you see this amount going up, you think, wow, I have X amount there already. And it also creates self-esteem. And it also creates a situation where people may be able to take a little bit more risk, like if they want to set up an enterprise or something like that. Yep. They're able to take a little bit more risk because they have some money saved. So it's not only for that situation that accidents happen or you need to go to hospital, etc., or maybe something positive happening in life, but it's also a general feel. Like if you feel rich, you attract more things, etc. So that's more of a different perspective, but it's something I think is very interesting about savings.
No, I love that idea. And I think Eunice has got a really interesting question, because I remember going back to your model where we were talking about 50-50 split. You also had an insurance product attached to that for death benefits. Eunice is sort of saying, are there any examples of where maybe sickness or medication or like general health rather than death insurance could be, or is included?
Yeah, in Vanuatu, we had a lot of discussions about that, where the general manager of the pension fund, he wanted to include that in the scheme. He wanted to make like a whole inclusive social protection scheme, but because of regulation, that was very hard. And we also thought maybe that's something for a later phase and not make things too difficult. On the other hand, you can say if you can have like a micro insurance tag to that, and it just takes out, I don't know, $1 a year for that assistance for sickness and medication, etc., that already helps a lot. But it also asks for a lot of administration and control. Like if somebody says, I need this medication, is it actually needed and in place? And it needs a lot more to be organized, while micropension itself are already quite difficult. And in our designs, we've always taken the stance to simplify things. So also for withdrawals, we've had many discussions with the teams we've worked with. They said, yeah, but we have to make sure they only withdraw like if somebody's really sick, or if somebody, something very bad happens, how do we control it? It's a family member, something happens. And if you get into all that checking and all this paperwork, it's very difficult. Mm-hmm. If you make it very simple, it's your money. You can withdraw up to 3 times a year, anytime you like. You don't really need controls to be in place, because you only say it's up to 3 times. So you kind of limit the amount of time people can do it. So they'll think 3 times before withdrawing. Mm-hmm, mm-hmm. So they'll only do it if it's really necessary. So you have the right incentive, and it's in the end, it's their money. So if they want to use it for a big wedding, let them use it
their
for
choice.
saving. Yeah, their choice.
And to wrap up the session, I just want to go to the last question, which is from Instill. How do we make pension savings attractive for low-income earner to participate without fear? So you've talked a bit about financial education and trust and having an agent. Are there any other hot tips that you might want to give us to sort of deal with that?
Yeah, I think I mentioned that before, is like, if you start working with platforms, make sure it always works. So that you don't have downtime and things like that, because with financial products and you're not being able to access them or not be able to get insights, that's where people get afraid. So if you create a platform where people can register and they can see their savings, so at any time they can on their mobile phone or with an app log in and see what their savings are, ideally what the interest rate is they've earned in the last year, and think, the last 5 transactions. This can also be very simple, like in the USSD menu, you do #123 and you get a message back showing you your balance and last 3 deposits. So that people, and that you have a place people can go to if they have questions. So if something is wrong, if they're uncertain about something, you need to have a place where people can go to, so they're not afraid to lose their money.
That face-to-face, you can't.
That face-to-face.
Everything can be done digitally.
Yeah, so customer service is very important to instill the trust you need for people to put their money away for a long period of time. Well, I hope that answers the question.
Yeah, no, I think that's great. I think you talked about the other elements as well, but going back to the sort of that platform issue and that reliability issue, I think, really reminds us actually the importance of the technology involved as well to be reliable. And no, I've had such a great hour chatting with you. I could keep going, but
me too. I could talk about this for another 3 hours.
So yeah, we will look forward to continued talks maybe, and hopefully on these kind of topics and more about savings. I've really enjoyed being quite pragmatic. It's great to understand the customer's needs, but also the kind of products that we can put in place to enable it to meet those needs and to run at a scalable process and what we need to think about. So thank you so much for sharing all the different examples that you have, so that we can sort of take that knowledge back and think about what can we do in our organizations to introduce these kind of schemes. And I really enjoyed the session, so thank you so much, and thank you also to everyone who joined us today. Well, I hope you enjoyed the session too, and we'll be sending a recording of today's session to you all hopefully tomorrow, along with also any of the links that Beryl would like to share with you, as opposed to Miguel's question earlier on in the webinar.
Yeah. Okay, thank you so much. If people have any questions, please reach out to me. Or if you would like to discuss anything further or see possibilities to work on saving schemes, because I'm myself very much interested in, like, how can we stimulate savings? How can you create product designs in a better way that creates savings, etc. So that's something I want to venture in more in the future. So if you have any ideas there, also please reach out to me.
Brilliant. Thank you so much, Beryl. Thank you, everyone. And we look forward to seeing you all in a webinar again soon. Have a great rest of your day, everybody. Bye.